We had a mixed day across the S&P yesterday. However, some of the notable losers were Palantir down 7%, Uber around a similar figure, and Eli Lilly down nearly 3%. Today, however, we want to focus on super microcomputers that has absolutely gone crazy, up around 30% in the pre-market. We're going to discuss why this company has shot up. We're going to take a look at how it has got to this position where it is trading at its 52-week lows, significantly down from the 52-week high. And we're going to take a look, run it through our valuation model, and understand whether or not this company is something to consider. Now, first thing that we do want to note is the reason for this large pop is that they hired a new auditor. For those that are interested, it is BDO and they will be taking over from Ernst & Young. And we can also see this is essentially still pending a review of the compliance plan from Nasdaq. If all goes to plan, then they won't be delisted, something that was hanging over their thread just last week. Now, how did they get to a position where this company has shot down very, very fast? First thing, let's go all the way back to August the 27th, where it did come out that Hindenburg had in fact taken a short position in super microcomputers. And for those that didn't know, the main reason for why they did this was that they believed or alleged that there was accounting manipulation within the company. Now, moving forwards to the following month, we have September the 26th, where in fact it was reported that the DOJ, the Department of Justice, opened a probe into this company. And again, for very similar reasons that we saw Hindenburg just the month prior take a large short position, was that there were allegations of fresh evidence of accounting manipulation. Now, it wasn't just the numbers, there were also the controls, as well as issues with some of the related parties of this company. But the news didn't get any better. We then move into the following month in October, where in fact maybe one of the worst news out of the history of SMCI was that their now previous auditors, EY, Ernst & Young, resigned after raising concerns. And actually it had been a few months since these concerns were raised, and ultimately within their resignation letter, EY mentioned they are unwilling to be associated with management's financial statements. A pretty poor thing to see in one of your companies when the auditors say this. A massive, in our opinion, red flag. Now, it wasn't just, as we said, the numbers, also the company's internal controls, the board independence, as well as we have here the accounting practices. So things were not looking good over the last few months, but again, we can see things getting even worse for this company. We then move into November early on. In fact, the company said they have no timeline for when they will release their annual results. And on top of that, when they gave their preliminary Q1, they said they've issued weak guidance. Now, none of these numbers could be verified, as we just saw EY had in fact resigned. So even to this day, we don't know what their Q1 numbers are, but we can see, thankfully, Super Microcomputers Board of Directors said that there were no evidence of fraud or misconduct from management after its auditors resigned last week. Now, that's a bit of sarcasm there. It's essentially auditing yourself. Supermicro themselves have looked and said, you know what, we found no evidence of fraud when some of the allegations were made around board independence. So what we have here is a classic self-review threat. Board of directors, who are also being questioned, have taken a look and said there's no evidence of fraud or misconduct. So if you do want to take this information at 100%, we would say, in fact, take it with a pinch of salt. We wouldn't really take this at its face value. Now, in terms of whether things got any better, we can in fact see just a few days ago, they did face a deadline from the Nasdaq, which they were told if they don't provide a viable compliance plan by Friday, which has already gone, then they will essentially potentially face delisting. And that didn't look too good. Bear in mind, this is a company that is down around 85% from the peak in March, and it wasn't too long ago that it was entered in the Nasdaq. Ultimately, for those who have exposure to the Nasdaq, you would have got all of the downside that SMCI has had and none of the upside. We can also see, while the delisting issue mainly affects the stock, the event, with no surprises here, would affect SMCI's reputation and standing with its customers. So a lot has gone on with this company, and as we've already mentioned, they will remain on the Nasdaq if they come back with the review of the compliance plan and say it all looks good, and they have now officially hired BDO. So question remains whether or not you believe that this company's numbers are all valid, whether or not you believe that moving forwards, all of the issues that we have just seen won't have any repercussions into the future. Now we're going to do a deep dive onto this company, but before we start, we just want to make you aware this is not one we hold in our portfolio. This is not one we are going to consider, and whether you want to add more, whether you want to sell, whether you want to hold, or whatever your position is as an investor, we just want to make it clear for us, due to the fact that the validity of the numbers has been questioned and it doesn't look like a good sign, this is not one for us. Moving on though, we will get into our full analysis where we do note over the last 12 months it is down around 30%, as we can in fact see up around 30 just essentially in the pre-market. Over the last 10 years, if you have been a longer term shareholder, you would have been up 547% if you haven't sold, but we can see this company did hit its peak around $123 in March this year. And we do note Quant actually give this a strong sell. Typically they would give this a hold, both seeking alpha and Wall Street in fact with the hold. And on a forward P, it does look very, very cheap. We'll compare it to the sector median, but at 7.42, that is at a massive discount. And there will be a lot of people in the community who may think, you know what, if BDO are coming in and the numbers do look to be okay, and in fact they don't get delisted, then actually we could see this company shoot up significantly and take a very massive gain. Again, just bear in mind the risks that also do come with this. In terms of their delisting process, nothing has yet been finalized. Now we also want to take a look at their latest investor presentation from their more recent earnings, just something to bear in mind. Firstly, their growth has been very good, 143% year on year in comparison Q4 revenue to Q3 of FY23, and just from the previous quarter they are up around 38%, and for the full year accounts up 110% year on year, triple digits, with the guidance, although this is now a little bit outdated as in fact they have lowered it. Previously, they were anticipating very high triple-digit growth year on year, and for the full year, in fact, as we can see, 74 to 101%. What will be interesting now is when BDO have essentially taken a look at the numbers to understand management for the full year of 2025, as well as the next few quarters, what the expectations are. And for those that want to see it in a tabular format, the one thing we would highlight, and we will show you on one of the next slides, is that their gross margins are down around 430 basis points from the previous quarter, 580 on a year-on-year basis. That isn't something we like to see. Remember, high quality companies not just increasing their top line revenue, but also their margins. Now in terms of the margin, again, just showing you a different format, it has been increasing at a very strong rate, and we're not really questioning this company in terms of its growth. We're questioning whether or not these numbers that they have produced, is it legitimate? And unfortunately, EY did stain that on us, given the fact they were unwilling to be associated with management's financial statements. Gross margin, something that we do want to see them start to pick up. It has been reducing quite significantly, in fact 17.1% in the same quarter last year, now 11.3%. Although given the fact that they have said it is down to the customer and product mix as well as the initial product costs on the new DLC technology, we do anticipate then, based on this information, we should start to see it pick up, something that whilst we're not invested in this company, we will look at when they release their next investor presentation. Non-GAAP EPS as well has been growing, although we do notice a drop from the previous quarter. Again, they do talk about this being based on the lower gross margins and the higher operating expenses. Now do remember they have lowered these forecasts, but previously these are the numbers they were anticipating. Nonetheless, we are expecting that even though it has been lowered, it still will be some very high numbers in terms of the growth. And again, we will take a look when BDO do come to release these figures. Now in terms of the expectations moving forwards to the EPS, nonetheless they are still expecting strong growth on a quarter by quarter basis, although we can see just in the more recent quarter they did miss, giving management essentially a 75% track record, 3 out of the last 4 are beats. And ultimately over the next full year they do expect 3.78 on the EPS, lowering the forward P to 5.7, which again a lot of people will argue is just too cheap if these numbers do turn out to actually be factual. We'll also highlight some of their metrics. Now in terms of the free cash flow, what we want to see is consistent growth on a year-on-year basis, not something we get. In fact, 23 to 2024 we see a massive drop, but nice to report over the next 12 months this is expected to pick up to around 76 cents per share. Then we get to the sales growth, where we see some very rapid increases in the more recent year, and as we just saw, they still expect that even with the lowering of the guidance to be a lot better than 22 and 23, and they were very, very good as well. So when we do zoom out for SMCI, 1.95 billion in 2015, 15 billion in 2024, so more than 7 times growth, although a large part of that has just happened over the last few years. Now, shares outstanding, they have diluted your position as a shareholder from 2015 to 2024, but again, if you are a longer term shareholder, given even after the drop, the share price has significantly outperformed the S&P, it probably wouldn't be a major worry to you at this point in time. Then we get to ROIC. We want to see 10% or more. Give us faith, management are able to effectively allocate their capital. Looking good over the longer term, 17% in terms of the more recent period and on a trailing 12 month. Now, when we get to the operating margin, at a minimum, we want to see 16% and we want to see operating efficiency, something that we have questioned in previous episodes. But good to note, from the lows of 2021 at 3%, it has started to move up, unfortunately, just not at a quicker rate than what we would like to see. And the free cash flow margin, very, very inconsistent on a year-on-year basis. Remember, minimum 5% is what we target here. Then we get to the final metric here, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. And this correlates to balance sheet strength. The numbers that you're seeing right now are the number of years it would take the company to pay off all of their debt net of cash on hand. And we want below 1.5 for this industry, 0.39 in 2024, 0.21 over the next 12 months. So balance sheet does look very, very strong. Again, just highlighting that the numbers and the actual true case of them have come into question. So just again, very important to flag that today. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we talk about severely undervalued stocks that we believe deserve your attention, as well as what's gone in the market over the last few days. So click below, sign up, and you can start reading straight away, where you'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street see over the next 12 months. And on top of that, you can grab a copy of 22 undervalued dividend stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, sign up, and you can start reading straight away. We then look at insider ownership that sits at just under 18%. In fact, one of the highest we have reviewed on this channel. And in terms of actual sales, around 49 million over the last 12 months. Although we notice no selling in Q4, no selling in Q3, you'd have to go to Q2 to see the more recent sell at 1.12 million. So we would say that is pretty outdated, as we can see here, the 3rd of June. But as always, we don't even believe this to be a bearish signal. Management sell for many reasons, personal and financial. And as always, you can see this information if you want to include it within your own investment thesis. We then get to essentially the institutional aspect, 84% ownership, 260 million worth of sales over the last year. In the same time frame, nearly double the amount of buying. So institutions have historically been very bullish on this company. And we also note in the more recent quarter, Q3, institutions are buying more. Remember, always do your own due diligence. Never copy blindly what insiders or in fact institutions do in terms of buys and sells. Now, we've already covered their top line, which has grown at a very rapid rate. Again, we'll just show you in a different format. But what we want to highlight in essence in this part of the analysis, what does the bottom line net income show us? And we can see a very similar trend, pretty much growth starting from around 2021. And we see massive jump in the more recent year. 93 million reported in 2015, 1.2 billion in that latest June 2024 annual accounts. So looking good in terms of following the trend, revenue increasing as well as the bottom line. And we also want to flag the health of this company, their total cash versus their total debt. As we already saw, their net debt to EBITDA did look very good. And we noticed their cash over the longer term has increased with a massive jump just from 23 to 24. 96 million in 2015. Now they hold around 1.7 billion in the latest quarter. And then when we compare it to their total debt, because as always, these numbers in isolation won't really tell us anything, we can see again pretty much the similar trend as their cash has increased sharply over the more recent period. 95 million in 2015, 2.2 billion in the latest quarter. So cash and total debt aren't far off each other. Net debt to EBITDA, as we said, just reinforced. Balance sheet overall does look to be good. We then move on to some gradings. Now, the first one is their valuation at an A+. Absolutely no surprises right now. Their P on a non-GAAP basis, 6.4, significantly lower than essentially the sector median at 24.5. which right now tells us if you are buying this company, you are getting a discount around 74%. Is it warranted? Again, something to consider. We've already been very clear with our own views, but no matter which valuation metric you are using today, SMCI is trading at a very, very large discount. We then move on to the growth where they get an A, and as we can in fact see, revenue year on year 110% in comparison, the sector median at 4, so a lot better. Moving forwards, again 62% versus the 6 of the sector median. And then we get to the earnings per share over the next 3 to 5 years, 37.5%, a lot better than the sector median of 15.09. So growth looks very good. And then we move on to profitability where they get a D. Gross profit margin not looking great at all, 14% versus the sector of 50%. And the bottom line, interestingly, actually looks better at 8 versus 3.6 of the sector. So if they can sort out their gross margins very quickly, then we could see this become very, very profitable, and this grade will significantly improve. We also notice from cash from operations, they are burning a lot of cash, negative 2.5 billion on a trailing 12 month. The sector median, whilst in fact very small, still positive at 93 million. And as a quick recap for this part of the analysis, seeking alpha in Wall Street a hold, essentially quant with the strong sell, and valuation A+, growth A, profitability a D. Now before we get to our own valuation, two things we want to highlight. Firstly, the comparison against others in the technology, hardware, storage and peripherals industry. What we noticed over the last 12 months, in isolation pretty much this company has suffered massively, negative 30%, although as we saw in the pre-market, we do expect this to go up. But we also get mixed performances from other comparables. Then when we look over the last 5 years, we can see SMCI the best performing, no comparison, although has come down significantly as we've already mentioned today. And over the last 10 years, even with that drop, it is still one of the better performing in line with Logitech. We then want to also show you the comparison against the S&P. As always, if you're investing in individual companies, you at least want to outperform the S&P, otherwise consider low-cost ETFs like VO. S&P, no surprises, outperformed over the last year. Over the last 5 years, we do see it underperform massively. SMCI, very strong return. And over the last 10 years, again, we can see, although it has come down very, very sharply. So now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $53, we're going to show you how we got that. But remember again, there is a large question around the accuracy of these numbers. So we have a growth rate of 15% here. We have low, medium and high. We also have the free cash flow year on year, essentially negative as it has gone from negative to positive over a large number of years. Now with the 15% growth rate and the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, intrinsically $53, indicating 88% upside. Now remember, these numbers are very subjective and you can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it's for SMCI or any others. But for full transparency, at the 10% rate, intrinsically $39, upside of 38%. And for those that believe it should be much higher, at the 20%, $72, that is more than a double from the current price, even after the pop, 156%. But we're going to take through the medium rate at 15%. And we always like to apply a margin of safety on this channel, where we start off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, in today's episode, a buy at $47, and then we keep going until it's near the current trading price. And even after the increase we have seen right now, you are getting around a 45% margin of safety, up to around $29. And Wall Street pretty much unchanged in their price target, $47 over the next year, upside of 68%. Now, as we said, for this company, our view is no matter what the margin of safety is, this isn't one we are looking to consider, but we've gone through 45% MOS, upside of 68%. Interested to hear your thoughts, whether you're buying after this increase, maybe you're actually looking to unload your shares, or maybe it is just a hold to wait and see what the future in the short term holds. As always, let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.